In April 2021, one company walked onto the Nasdaq and did something almost no one had done before. No IPO roadshow, no bank set price, just a direct listing, opening above $380 a share, instantly valued around $85 billion. This is the story of Coinbase, and here's what actually happened next. 14 months later, that same company was cutting a fifth of its staff. Its stock had lost more than 80% of its value, and a lot of people, inside and outside the company, quietly wondered if it would survive at all. Coinbase was founded back in 2012 by Brian Armstrong and Fred Ehrsam. The idea was straightforward: make it simple for ordinary people to buy and sell crypto. For most of the next decade, that bet paid off. By early 2021, the company had grown from around 1,250 employees to roughly 5,000. Bitcoin was on a tear, retail investors were piling in, and Coinbase rode that wave straight onto the public markets. Then 2022 happened. Bitcoin had hit a record above $69,000 in November 2021. By June 2022, it had fallen to around 23,000. Trading volumes collapsed. And when trading volumes collapse, Coinbase's core business collapses with them, because transaction fees were the engine of its revenue. On June 14, 2022, Coinbase laid off about 1,100 people. 18% of its workforce, gone in a single announcement. CEO Brian Armstrong told employees the company had grown too quickly during the bull market, and that a recession looked likely. He said Coinbase had $6 billion in cash on the balance sheet. That sounds reassuring. But saying it out loud, in a layoff memo, told you how seriously leadership was taking the threat. It got worse before it got better. That November, FTX, one of the largest crypto exchanges in the world, collapsed almost overnight amid allegations of fraud. The entire industry's credibility took a hit. Regulators circled. Retail trust evaporated. And in January 2023, Coinbase cut another 950 jobs, roughly 20% of what remained, specifically to reduce operating expenses by 25%. By that point, the numbers told a brutal story. Coinbase's stock, which opened above $380 at its direct listing, had fallen more than 85%. In its first quarter of 2022 alone, revenue dropped 27% year over year, and the company posted a loss of $420 million, a sharp reversal from a $771 million profit the year before. For a company that had just gone public with enormous fanfare, this was about as public a failure as it gets. Headlines asked whether Coinbase, and crypto exchanges generally, could survive a prolonged bear market at all. So how do you come back from that? Not with a single dramatic pivot. With a slow rebuild of the actual business model. Coinbase leaned hard into something less flashy than trading fees: subscription and services revenue, built largely around stablecoins, custody, and staking. Unlike trading commissions, that kind of revenue doesn't evaporate the moment prices drop. It became the foundation the company rebuilt on. The rebuild started showing up in the numbers. Total revenue climbed from about $3.1 billion in 2023 to $6.6 billion in 2024, and roughly $7.2 billion in 2025. Coinbase also built a dominant position in a market most people don't think about. When the first U.S. spot Bitcoin ETFs launched in January 2024, Coinbase became the custodian behind several of the largest issuers. By 2025, it was holding more than 80% of all U.S. Bitcoin and Ethereum ETF custodial assets. Wall Street's biggest funds were quietly trusting Coinbase with their crypto, even while retail sentiment toward the company was still recovering. Then came the validation moment. On May 19, 2025, Coinbase joined the S&P 500, the first crypto-native company ever added to that index. The announcement alone sent the stock up 24% in a single day, the kind of jump usually reserved for major earnings surprises. Passive index funds were now required to buy Coinbase stock just to track the benchmark. It was one thing to survive the crash. It was another thing entirely to sit alongside Apple and JP Morgan Chase in the index that defines what counts as a pillar of the American economy. 3 months later, in August 2025, Coinbase closed a $2.9 billion acquisition of Deribit, instantly making it the dominant regulated platform for crypto derivatives trading. The company that had been laying off staff to survive 3 years earlier was now making billion-dollar acquisitions to expand. Is the story finished? Not exactly, and that's worth being honest about. Coinbase's stock hit an all-time high above $444 in July 2025, then fell more than 60% in the months that followed, landing well below its S&P 500 debut price by early 2026. Trading volumes remain volatile, and revenue tied to transactions still swings hard with crypto prices. The company hasn't returned to its 2021 valuation, and probably won't anytime soon. Crypto markets are still crypto markets. But look at what actually changed. A company that cut 40% of its workforce across 2 rounds of layoffs, that posted hundreds of millions in losses, that watched its stock crater alongside an industry-wide collapse, rebuilt its entire revenue engine around something more durable than hype. It didn't do it by predicting the next bull run. It did it by making the business survive the next bear market first. That's the real lesson underneath the ticker symbol. In 2022, Coinbase looked like a cautionary tale about crypto excess. By 2025, it looked like the clearest proof that a crypto company could behave like a durable financial institution. Both of those things happened to the same company, 3 years apart. The exchange that nearly didn't make it is now the one regulators, index funds, and Wall Street itself treat as the standard-bearer for the entire industry. If you want to understand the companies quietly reshaping tech before everyone else is talking about them, subscribe to Tech Business Secrets. New breakdowns of the founders, the funding, and the numbers behind the products you use every day, dropping regularly, right here.